the price can go to the moon, well over $3,000 an ounce in gold, and much, much, much higher in silver. So much so, and I don't like to make predictions, but I would make a prediction that we see a really strong rally into the end of the year as a result of this. And this is just the very beginning. It will be an interesting thing to watch. We'll see what happens over the next few days. There were big premiums on future, on spot over future, the other way around here, not there, and rightfully so. We've shown that weaponization is something that we're okay doing. Venezuela and Afghanistan both asked for their gold back from the LBMA, and they were denied. And so when you see, for example, the People's Bank of China buying huge amounts of gold from the LBMA, they're immediately repatriating it.
In today's news recap, gold price holding its ground near $2,700 as U.S. annual CPI rises 2.7% in line with expectations. Gold prices are holding within striking distance of $2,700 an ounce as stubborn inflation fails to drive investors out of the marketplace. The consumer price index rose 0.3% last month after October's 0.2% rise, the U.S. Bureau of Labor Statistics announced on Wednesday. The inflation data was in line with expectations. The report stated that in the 12 months leading to October, headline inflation rose 2.7%, also in line with expectations and up from September's 2.6% print. Core CPI, which excludes volatile food and energy prices, increased 0.3% in November, matching expectations and mirroring September's 0.3% reading. The report also noted that annual core inflation rose by 3.3% last month, unchanged from October's reading and consistent with expectations. Although inflation has moved higher, there were no major surprises to unsettle investors. The gold market is seeing some modest buying, but remains close to neutral territory. Spot gold last traded at $2,698 an ounce, up 0.15% on the day. While inflation remains a concern, economists note that the data contained no major surprises that would deter the Federal Reserve from cutting interest rates next week. However, uncertainty surrounding the easing cycle in 2025 continues to grow. Risks around the monetary policy outlook are set to become increasingly two-sided in the first quarter of next year. Chiefly, policymakers will be concerned about the potential upside inflation risks stemming from incoming President Trump's tariff plans, as well as the broader reflationary fiscal stance, whereby strong demand could further fuel price pressures, said Michael Brown, senior market researcher at Pepperstone. On the whole, the pace of policy normalization is likely to be much slower in 2025, with the FOMC plotting a more deliberate course as rates move closer to a neutral level, likely around 3%. Now, we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and check the pinned comment because we're offering an exclusive discount on NordVPN, an essential tool for gold and silver stackers who value privacy and security. Make sure you safeguard your online activity and protect yourself from prying eyes. And if you want to learn how to stack and how you can benefit from the gold-silver ratio to make savvy investment decisions, check our guide at goldsilverstacks.com. Enjoy the episode.
You will see a massive drive to cover short positions that are back naked, and the metal has to come from somewhere. Often it does come from London. They would end up putting a 10%, a 15%, who knows how high that tariff is. But this is why you're seeing short covering that pushed the price up over the last few days. And this is also why you're seeing a big spread between London spot and the futures by as much as 3%. These traders are basically saying, if we don't do this now and close out our position, if he puts the tariffs on, we're dead. The price can go to the moon, well over $3,000 an ounce in gold, and much, much, much higher in silver. So much so, and I don't like to make predictions, but I would make a prediction that we see a really strong rally into the end of the year as a result of this. And this is just the very beginning. It will be an interesting thing to watch. We'll see what happens over the next few days. It was the other way around. There were big premiums on future on spot over future. The other way around here, not there, because there was worry about the ability to get metal here because of the supply chain disruptions. And so you would see the price $70, $80 higher than the futures price. Well, it's the other way around now because they're basically saying in the future, you put these tariffs on, prices are going to go way higher. And you look into the on the futures market right now and look into the March contract, and the prices are way higher than spot is right now. It's very bullish for both gold and silver, and underscores how stupid these banks are. It also underscores the sensitivity of the precious metals market to things like policy developments or geopolitical risks, where just like that, things change. And this is all happening kind of under the radar as most people are fixated on what we've seen with cryptocurrencies. They're not noticing this. And here we are right back up above 2,700 as we speak right now. The gold is almost 2,730, pretty darn close to where it was before all of this started. Silver is just over $32 an ounce. So we're climbing right back to where we were. The banks were able to cover a bunch of their shorts. And here we go, back to the upside again. Only now you have something that could potentially usher in, honestly, a real squeeze. A squeeze because these short positions are massive. 700 million plus ounces of silver on COMEX, 4 to 6 billion ounces short on the LBMA. I mean, this is rocket fuel type of potential if this continues to move the way that it is.
In today's episode, Andy Schectman dives into the art of stacking gold and silver the right way. He emphasizes that successful stacking isn't just about accumulating metals, it's about a strategic approach that ensures long-term security and financial resilience. Schectman stresses the importance of prioritizing physical metals over paper-based assets, noting that true wealth lies in tangible ownership. He also highlights the value of balancing gold for stability and silver for its growth potential, helping stackers build a well-rounded portfolio to withstand economic challenges. Schectman shares his bullish outlook on precious metals, citing critical macroeconomic factors like rising inflation, unsustainable government debt, and the global trend of de-dollarization. These, he explains, are driving demand for gold and silver as essential hedges against economic uncertainty. He is particularly optimistic about silver, praising its unique dual role as a monetary asset and a key component in green technologies like solar panels and electric vehicles. With industrial demand poised to surge, Schectman believes silver's potential is unmatched. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and check the pinned comment. We're offering a big discount in NordVPN, which is an essential tool if you want to browse the internet in a secure and private way. For just a few dollars a month, make sure your privacy is never compromised.
Rightfully so. We've shown that weaponization is something that we're okay doing. Venezuela and Afghanistan both asked for their gold back from the LBMA, and they were denied. And so when you see, for example, the People's Bank of China buying huge amounts of gold from the LBMA, they're immediately repatriating it so that they too are not going to be or risk being denied access to their reserves. And so this is a big deal. And I think people need to understand that the exchanges on the West, I think, have an expiration. You're seeing the cumulative volume of the Shanghai Metals Exchange and the Shanghai Futures Exchange has overtaken that of the COMEX, rendering it the number 2 most frequently and actively traded market in the world. We are hearing rumblings, of course, of the BRICS building their own metals exchange, and I do believe that is exactly what is in the cards. These countries have been using our suppression, our naked shorting, which we're going to talk about in a moment, which is as dumb as a mud wall, against us, and standing for delivery and repatriating the metal. And this is something that I don't think will change. I think they'll continue to do it. They'll continue. And the reason they didn't yank it all is that they want to continue to play the game. And that game, in my mind, is continuing to allow the West to be stupid enough to suppress the price of gold and silver.
Yep.
And they will stand for delivery. This is an option that never happened before. And as I've said on your show a million times, the countries that have done this were never coordinated, motivated, or sophisticated enough to do it, or wealthy enough. Now they are on every level. And it ultimately will bleed the system dry. And they have to do it in a very methodical manner in order not only to get the most that they can squeeze out of the system, but also for the system not to just immediately break. The COMEX would break immediately and would go force majeure and would be cash settled. Instead, they have been using something called exchange for physical, which is where you buy a contract in the West and have it delivered in places like London, in places like even Hong Kong, where there is a contract, a COMEX contract delivers to Brinks Hong Kong, where then it is picked up by a Brinks truck and delivered to the Shanghai Metals Exchange. And it's ironic that most of the gold that is delivered off the COMEX is part of their mini contract kilo bar form, which is what is traded primarily in China. In fact, when the 400-ounce good delivery bars are bought off of the LBMA, they are immediately refined into and melted down and refined into kilo bars just to erase all trace of them whatsoever. And we talk about the exchange for physical. Now, the premium on exchange for physical has shot through the roof, and it happened a day or two ago. And everyone only thinks of exchange for physical going from west to east, but oftentimes when you have these naked short positions on COMEX and there is a delivery, there will be exchange for physical coming back to the west, coming from, let's just say, London, and to be able to make good on deliveries. And the premium on this just shot right off the chart a day and a half ago, which is a big deal because it signals a tightness, if you will, in these bars. Now, what it really means is something that I think it's very interesting going forward with the Trump administration. And what's going on with the premiums and the futures price in gold today was up by over $60 an ounce, or 2% above the New York or the London spot. Silver was up $1 over London spot, a 3% difference. This is on the futures. And the reason that this is happening is that there has been rumor that Trump is going to put tariffs on precious metals that are coming into the country. And you have all of these naked shorts that are freaking out. And
what are your thoughts on Andy Schectman's interview? Do you agree with his predictions? Do you think the BRICS nations could challenge the US dollar and disrupt the American economy? Could gold really blow up in 2025? Drop your honest opinions in the comments and let the stacker community know if you're investing in miners or prefer sticking with physical metals. Thanks for watching. Don't forget to check out this video over here. I'm sure you'll enjoy it. I'll see you on the other side.